4 months from the date this notice to creditors is published.
Okay. Now, does having a trust mean it takes less time to administer property after a death? And why would that be the case?
It certainly, as a general answer, the answer is yes. It should take much less time than a formal probate proceeding under a will. And the reason for that is you're not under court supervision for the most part. You do not have to opt into court supervision. You may be brought in involuntarily. But when you're under court supervision, you have differing deadlines. We've administered some trusts, some very complex trusts with overseas beneficiaries in as little as 6 months. In most probates, I would suggest that the average time would be 9 months to 12 months post-death. So trusts are much speedier to administer than the corresponding administration with the will. But that doesn't mean they're universally so. You can have lots of issues in a trust depending upon the nature and character of the assets, depending upon the family, depending upon the creditors of the decedent, that can prolong the administration.
Okay. Are additional trusts typically created from a single living trust? And what purposes can these trusts serve? How long do they typically last?
Well, let's give you a very generic sort of example. Suppose you are divorced and the mother of 5 children, and the children are minors, and the mother dies in an accidental, as a result of an accidental death. More often than not, that trust will create ongoing trust for each of the children until they attain a certain age as whatever the settlor desired. So it's not uncommon in that situation that we could have ongoing trusts for the children. In a married couple situation or in a domestic partnership, we may very well have trusts that divide at the first death into either 2 or 3, sometimes more, we call them subtrusts, that are for the lifetime of the surviving spouse. So these ongoing trusts may very well go on for the lifetime of a spouse. They may go on for the lifetime of a child, a generation skipping trust, for example. If there is a disabled beneficiary or a beneficiary, a child, for example, who might be on some sort of public benefits, more often than not, the creator of the trust will have created a trust, sometimes called a special needs trust, for the benefit of that disabled beneficiary that will last his or her lifetime.
Okay. Many people have informal habits related to their record keeping. So, they write their checks from their checkbook. They may not even write them into the checkbook. They may omit that. They may write in a deposit with, just deposit the total amount.
Are you talking about me?
I hope not. Well, anyway, so is that sort of record keeping, is that acceptable for a trust, or what other things should you be thinking about?
If you are the settlor of the trust and the trust is revocable, that sort of record keeping is fine, because I don't care. Nobody cares. You have the power to revoke. You can change it. You can do whatever you want with it. And if you're very informal in your record keeping, I'm sure your CPA will be able to assist you at the end of the year in preparing your taxes. But once the settlor is deceased, once this trust goes from revocable to irrevocable, and once you come on as a successor trustee, that sort of record keeping is not desirable. And in fact, you can get in a lot of trouble if you don't keep good books and records for the trust, because a trustee has to account to the beneficiaries of every penny that comes into that trust, every dime that gets spent from that trust, and any change in the nature of the assets, a liquidation of one asset, the acquisition of a different type of asset. So the record keeping and accounting is critical in the absence of any sort of a waiver by the beneficiaries.
Right. So that means things like making copies of your deposit. What are the various items that are being deposited at a time and so forth like that is a very helpful thing to do, for example.
Oh yeah, we tell, in our situations, once we try to assess, are we going to have any difficulties with beneficiaries or not, Are we going to be able to get waivers of accounting or not? We will tell our clients, I want you to make copies of every deposit check that goes in there, and oftentimes deposit them separately so we can have separate records of every deposit check. That's not critical as long as you have records of the deposit and what were the components of a particular deposit. More importantly on the expense side, because most beneficiaries aren't looking at the deposit side, they're looking at what did you spend money on. I want canceled checks. I want to know what you spent. I want to know what was the purpose of the expenditure. I want to know if the person or the payee was related to the trustee in any way, shape, or form, because there are all sorts of rules that govern in the accounting. And so record keeping is very critical in the vast majority of cases where I have to do an accounting. In many families where everyone trusts the trustee, we can get waivers of accounting and save the beneficiary some money.
Now, one thing related to this is a lot of banks these days are giving abbreviated statements. They're not including the check copies and so forth in all cases. So you'll want to request that information related
Typically,
to your trust.
we'll advise our clients to, when you open up a trustee checking account as successor trustee, make sure that the financial institution will provide you with copies of the canceled checks so that we have a record of them.
Okay. What tax returns are required for trusts, or after a death situation?
In the typical situation, Mike, where dad dies, one of the children are taking over as successor trustees, the taxes and tax returns that must be prepared would be the decedent final personal income tax returns, forms 1041 for federal and 541 for California. And then, in addition to the decedent's final tax return, we'll also have what's called a fiduciary income tax return for the trust. These are forms 1041 for the federal government and form 541 for California. These start at the moment of death and can go out either to the end of the calendar year, and if a certain election is made, we can elect a fiscal year reporting basis for those. And then finally, we could have, in a very large trust, if the estate is in excess of the exemption amounts, which currently are $3.5 million, and I'm not sure what they're going to be for 2010 yet, but we hope to find out, we could have a federal estate tax return that's required. California no longer has an inheritance tax, hasn't had it since 1981, so there's no corresponding California pickup tax or inheritance tax.
Okay. The property tax situation, we have reassessment in California. Are there some concerns related to that after a death?
Anytime a decedent who had created a trust has real estate, there's a property tax issue. The question becomes is there a change of ownership as a result of the death of the deceased settlor? And the answer is the change of ownership occurs with death. Is there an exemption that applies? So if the property goes from the deceased settlor to a surviving spouse or domestic partner, there's an exemption that applies. If it goes from the deceased settlor to children, there's exemptions that may apply, and in some cases even grandchildren. So there may not be a reassessment if the person receiving the property is closely related, but otherwise there will be a reassessment and a supplemental property tax will be issued, which frequently will come as a shock if the decedent had owned the property for a long period of time.
Okay. Well, Bob, we're all out of time. Thank you again for being my guest today and sharing this information with us.
My pleasure.
If you would like to get more information about Bob's firm, his law firm's website, tcklawfirm.com. To write to me, Michael at financialinsiderweekly.com.
Thank you.
Okay. Yay.